Hello learners, in this lecture we shall try to understand the final computation of tax liability on net income, which includes detailed understanding of salary income and if at all we have income from other heads along with deduction under section 80C. So far, we have done everything that makes up your gross salary, allowances, perquisites, leave salary, perquisites, pension. On gross salary, we give certain deductions to arrive at the figure of net salary, which becomes a part of gross total income. And to arrive at net salary on gross salary, we give three deductions. One, standard deduction, which is a flat amount of 50,000, or if salary income happens to be lower, then the lower figure. 2, entertainment allowance. For non-government employees, there is no deduction on account of entertainment allowance, but for government employees, after computing gross salary, we give deduction on account of entertainment allowance, which is least of the three figures. One being lump sum. We have very widely understood the meaning of the term lump sum, which means deduction cannot be more than 5,000. 20% of basic salary. So we neither consider DA nor commission, only basic salary. And 3, actual amount of entertainment allowance. So least of these three, if at all employee is a government employee, is deductible from gross salary. And third is professional tax. Any professional tax paid in the previous year is deductible. Remember, payable is not deductible, paid is deductible. If the professional tax is paid by the employer, then it becomes obligation of the employee discharged by the employer and therefore becomes a perquisite. So if employee's professional tax is paid by the employer, we first include it in the salary as perquisite and then give a deduction from gross salary. And that becomes your net salary. On this net salary, if at all, let's say your net salary is, 12 lakhs. And your income from other sources is, let's say, 2 lakhs. So, your gross total income becomes 14 lakhs. Now, to pay tax on this gross total income, we provide certain deductions, and those deductions you will do in detail later. They are deductions under section 80C to 80U. We will do one of these deductions, that is 80C. Now, what is 80C? Deduction under 80C is available, as I've just told you, on gross total income to arrive at the figure of net income. It's available of all assessees only to individuals and HUF on deposits and payments made by the assessee during the year. Certain deposits and certain expenditures, payments. However, 80C is clubbed with two more sections, 80CCC, which is pension fund, and 80CCD1, which we have done in earlier lectures, employees' own contribution to NPS. So together 80C, 80CCC and 80CCD1 cannot be more than 1,50,000. So you just add up all the deductions. If total happens to be more than 150, provide 150. If total happens to be less than 150, then that is the amount of deduction that the assessee can claim. Now, to give deduction under 80C, there are two things that one must know. One is the gross qualifying amount, another is the net qualifying amount. Gross qualifying amount means total amount of deposits and payments made by the assessee during the whatever you may be investing in. We just keep on totaling it. So that is the gross. But net qualifying amount is the amount on which actually deduction can be claimed. So let's say you have invested 5 lakhs in a year. So would 5 lakhs be available for ATC? No. For the purpose of deduction, your gross qualifying amount becomes 5 lakhs, but your deduction would be limited to 1,50,000. So it is primarily 150 or GQA, gross qualifying amount, whichever is less. That is, if your gross qualifying amount itself is less than 150, say you have invested 130, then ATC would be 130. If it is say 180, then your ATC would be 1,50,000. Now, what is gross qualifying amount for the purpose of ATC? Which means what all deposits and payments are eligible for deduction under ATC. We have a long list of investments. We have a long list of payments which are eligible under section ATC. To pick up a few important ones, it includes investment in Public Provident Fund, PPF. We have just done the concept of Provident Fund. Anything that you invest in Public Provident Fund qualifies for deduction under ATC. However, you cannot invest more than 1.5 lakhs in Public Provident Fund. Other investments can exceed 150, but your PPF cannot exceed. Bank will not accept more than 150 if you make investment in PPF. And receipts on maturity and withdrawal, so far as the tax loss till date are concerned, any money that you get back on maturity or any money that you withdraw from PPF is free from tax. Contribution towards statutory provident fund and recognized provident fund. We have done it in the last lecture. If you contribute anything towards your statutory provident fund, given that you are a government employee, or recognized provident fund, given that you are a non-government employee, your contribution qualifies for ATC. Investment in national savings certificates. If you invest anything in NSCs, that investment qualifies for deduction under ATC. Now, maturity period of NSCs is 5 years. When interest accrues, you get the matured amount after 5 years. Interest does not get paid to the assessee after every year, but it gets accumulated to your NSC account. Now, let's say you have bought NSCs for 10,000. You will get deduction for 10,000. But in the next year, when interest accrues on that, let's say interest is at the rate of 7%, let's say 700. That 700 will be treated at two places. One, that interest would be treated as your income from other sources. And two, that interest is deemed to be reinvested for the purpose of ATC. So, interest accumulated on NSCs purchased in earlier years, depending on the year for which you are calculating interest, first year, second year, third year or fourth year, that also becomes eligible for ATC. Then deposit in Sukanya Samriddhi account. This benefit is available only for a girl child. So, if the assessee has a girl child, he can open a Sukanya Samriddhi account and deposit 1,50,000 in it. And together with other investments, this also qualifies for deduction under ATC. Investment in fixed deposit. Any fixed deposit does not qualify for ATC. It is fixed deposit only with a tenure of 5 years or more. So, if it's a 5 years tenure of fixed deposit, that qualifies for ATC, but 1, 2, 3, no deduction under ATC is available. Premium on life insurance policy. One, when we talk of insurance, one, we have a policy amount which is called sum assured. Two, we have the premium that we pay on that sum assured. So, it is the premium for the policy amount that is eligible for deduction under ATC, and that too subject to certain concepts. One, policy can be taken on the life of self. You can take a life insurance policy for your own life, or life of your spouse, or life of your child. The child could be a major child, minor child, married, unmarried, it could be a girl or a boy, dependent or independent. So even for a working child, if you take a life insurance policy and you pay the premium out of your income, that qualifies for deduction under 80C. But the amount of premium is subject to a maximum limit. If the policy is taken during 2012-13, then it is either 10% of sum assured or actual premium, whichever is less. For policy taken prior to 12-13, it is 20% of sum assured or premium, whichever is less. And for policy taken after 13, it is 10% of sum assured or premium, whichever is less. And if the policy has been taken on the life of any of the people that we have discussed, and that person is suffering from disability or covered under section 80DDB, which you will learn in deductions, then up to 2012, it is 20% of sum assured, that's the limit. During 12-13, 10% of sum assured, so it's same as that for any other person. But for policy taken on or after 2013, against 10%, here the limit is 15% of sum assured. So, if let us say on 1st May 2020, you have taken a life insurance policy worth 1 lakh and you pay a premium of 12,000 for the year 2021. The amount that will be eligible for 80C would be what? It's taken in 2020, so it is limited to 10% of sum assured. So 10% of sum assured would be 10,000. You are paying a premium of 12,000. So amount that will be considered for the purpose of deduction would be 12 or 10, whichever is less. So you have to be a little careful about the premium amount that is eligible for deduction under 80C. Then equity oriented mutual funds. Any investment made in units of any mutual fund eligible for 80C. Repayment of principal amount on housing loan. If you have taken a housing loan, the principal amount is eligible for 80C and the interest that you pay on that loan will be taken care of under the head income from house property, which you will study later. Tuition fees. Tuition fees paid for full-time education in any school, college or university is also eligible for deduction under 80C, but for a maximum of 2 children. So, tuition fees paid for 2 children is eligible for deduction under 80C. It is only tuition fees. It does not include donations or any kind of capitation or development fees. There is no deduction for that. Any amount deposited under senior citizen savings scheme. So, who is a senior citizen? Who attains the age of 60 anytime during the previous year. So, if you are a senior citizen and you invest under the senior citizen savings scheme, that also qualifies for deduction under 80C, and 5-year time deposit with post office, similar to 5-year deposit with bank by virtue of FD in bank. Any deposit with post office also qualifies for the purpose of deduction under 80C. Now, this we have understood the limit on the amount of premium that qualifies for 80C. As an example, we can understand this, that there is contribution towards PPF. If 15,000 is contributed, 15,000 is eligible for 80C. RPF 24,000, entire amount is eligible for 80C. Insurance premium on own life 5,000, policy amount 40,000, it is limited to 10%. So, premium is 5 but eligible amount would be 4. NSC is purchased worth 80, amount eligible for 80C 80. Premium on the life of father. Any premium on the life of father is not eligible for 80C. So, whatever is the amount of premium, it is not eligible for deduction under 80C. Tuition fees of son. You have just one child, 36,000 you pay for the year, 36,000 is eligible for 80C. So, when you add them all, you have a gross qualifying amount of 1,59,000. And we have discussed deduction under 80C cannot exceed 1,50,000. So, of this 159, you can claim a deduction of 1,50,000. So let us say that here you have say a gross total income of, say we have done here 14 lakhs. So you can claim a deduction of 1,50,000. So your net income becomes 12,50,000. And it is this net income which is actually taxable income. So on this 12,50,000 now we have to pay tax. So let's understand how tax liability is calculated. The basic format for computing tax liability is something that we have done earlier partly and partly we'll take up later. Gross total income, we have done 14 lakhs. Deductions under ATC, we have a hypothetical case here also. Let's say gross total income is 7 lakhs. Then we give deductions under ATC to ATU. Let's say we have ATC of 1 lakh. Balance is your net income. So net income is say 6 lakhs. On this we shall calculate tax. We'll do the calculations later. Let's say we have 20% of tax on the 6 lakhs minus 5 lakhs, which is the exemption limit for a super senior citizen. We'll do a little while from now. So the tax liability is 20,000. Now up to here we have computed the tax. This liability may be subjected to rebate under section 87A. May be subjected to. So if certain conditions are satisfied, we may give rebate, otherwise not. This may further be subjected to surcharge. Again, if certain conditions are satisfied, we give surcharge, otherwise not. So let's assume here that there is neither any rebate nor any surcharge. So your tax is 20,000. But compulsorily on this, we add health and education cess of 4%. Has to be added. Whether you are subjected to rebate or not, you are subjected to surcharge or not, cess of 4% has to be compulsorily given on this. So 20,000 plus 4%, 800, and your tax liability becomes 20,800. So this is it. If you have to pay some interest or penalty for certain defaults, say there is late filing of return or late payment of advance tax or non-payment of advance tax, then section 234 applies for interest and penalty. You have 234A, 234B, 234C, 234F. It's a recently introduced section. So if at all there is any penalty, this will be auto-reflected when you file your income tax return. That has to be added. And that would be your final tax liability, on which if you have already paid any taxes, let us say from this 20,800, you have already paid taxes worth, let's say 20,000. So if you have already paid 20,000, your balance liability to pay, say 20,000, your balance liability to pay tax would be 800. So any taxes paid would be deducted and rest of it you have to pay. Now what is the tax structure? With effect from this assessment year 21-22, there has been an introduction of section 115.115 BAC, where you are given two tax regimes. One, an already existing tax regime, and two, a new tax regime. So you have two rates of taxes for the same set of income. For the old regime, your salary and other incomes will be computed the way we have been discussing. For the new regime, there are certain exemptions and deductions which are not allowed, and therefore, since your income goes up, your tax liability in terms of tax rates goes down. So alternately, the assessee has to make a choice. You compute your tax liability under the old regime with all exemptions and deductions under section 80. You compute your tax liability under new regime without any exemptions and deductions, and whichever suits you better, you can opt for that, and every year a salaried employee can change his option of paying tax as per the old or the new regime. As per the old regime, this is our tax structure. We have three categories of individuals. One, less than 60 years. Two, 60 to 80 years. And three, 80 years and above. So 60 to 80 during the previous year, along with you being a resident, ordinarily or not ordinarily. The assessee is called a senior citizen. And 80 or more during the previous year, along with being a resident, you are called a super senior citizen. So if an assessee is 80 years of age, but he is a non-resident, then this category of taxes will apply to him. Then this higher benefit of exemption will not be available. It's available only if one, age, and two, you have to be a resident in India. Now, first 2,50,000 is exempt from tax. There is no tax on first 2,50,000. On the next range of 2,50,000 to 5 lakhs, which means a range of 250. So, first 250 exempt, next 250 is taxable at 5%. Then next 5 lakhs, that is 5 to 10, is taxable at 20%, and anything beyond that, highest rate of tax, 30%. So if you have income of 10 lakhs, the first 250 would be exempt, remaining 750, next 250 would be taxable at 5%, 5 lakhs gone, remaining 5 lakhs taxable at 20%. For a senior citizen, it's the same structure with the difference that this 250 becomes 3, and therefore this 250 to 5 becomes 3 to 5. So income which is taxable at 5% for a senior citizen is 2 lakhs, while for a non-senior citizen it is 2,50,000, here it is 2 lakhs. And for a super senior citizen, thus 5% of tax slab does not exist. Why? Because his tax exemption limit is 5 lakhs. So 250 and next 250, 3 and next 2. So 5% tax rate does not apply to a super senior citizen. Up to 5 lakhs, his income is exempt from tax. So for 20%, it is same for all categories. 5 to 10, 20%, 5 to 10, 20%, 5 to 10, 20%. And beyond 10 lakhs, we have a tax rate of 30%. And on this 30%, after adding all these taxes, 5, 20, 30, we add cess of 4% after applying your rebate under 87A if applicable, after giving surcharge if applicable. So when is surcharge applicable? If net income falls in the tax bracket of 50 lakhs to 1 crore rupees. Surcharge is 10% of tax. From 1 to 2 crores, surcharge is 15% of tax. So 5%, 20%, 30% added of that tax at 10 or 15 or 25 or 37 as applies. Net income from 2 to 5 crores, 25%. And if net income exceeds 5 crores, surcharge is 37% of tax. And after adding this surcharge, we add another 4% as health and education cess. The income tax slab is same for men and women. And tax rebate under section 87A is available if income is up to 5 lakhs. So when is 87A available? If your income is up to 5 lakhs. So up to 5 lakhs, your tax rebate under 87A is either 12,500 or actual tax, whichever is less. So let's say your income is 4 lakhs. On this 4 lakhs, 2,50,000 is what? 2,50,000 is first slab exempt from tax. So you are left with 1,50,000. And on next 250, we have a tax of 5%. So 1,50,000, 5% would be what? 7,500. Now since this is less than 12,500, we shall give rebate under 87A, which is the entire amount of tax of 7,500, and the tax liability becomes 0. For the new regime, let's have a comparative understanding of the old and the new regime. As against old regime, the new regime has a slab of 250 each. For every increase in 2,50,000, tax rate goes up by 5%. So first 250 nil, 250 to 5, 5%, 5 to 750, 10%, 750 to 10, 15%, 10 to 12 lakhs 50,000, 20%, 1250 to 15 lakhs 25%, and above 15 lakhs 30%. So as against 30% that applies to income above 10 lakhs in old regime, in the new regime 30% applies to income above 15 lakhs. So the benefit is there, but there is no benefit of exemption, there is no benefit of deduction. So accordingly, your income also goes up. So if income goes up and tax rates go down, you have to actually make a comparative analysis. There is no change in surcharge, no change in health and education cess, no change in rebate. All these remain the same as applied to old scheme. These deductions not allowed under the new regime. Standard deduction 50,000 not allowed. 2 lakhs of interest on loan for self-occupied house property, section 24B, not allowed. Exemption on house rent allowance, children education allowance, hostel allowance, income of minor child, 1,500, not allowed. Standard deduction on family pension, not allowed. Section 80C, triple C, CCD, 1, D, DDB, E, EE, A, EEB, G. No deduction is allowed under section 80C to 80U except one. Only one deduction continues in the new regime, which is 80CCD2. And 80CCD2 is what? Contribution to NPS by the employer. So see, we can have a hypothetical example for income of 12 lakhs. Though of course the income for old and new regime would differ, because for the new regime we shall add back the exemptions and deductions. But if you have an income of 12 lakhs, say for a non-senior citizen, we have done this calculation, 250 would be nil, next 250 5% 12,500, next 5 lakhs 20% 1 lakh, and remaining 2 lakhs 30% 60,000. So your total tax liability comes out to 1,72,500 for a non-senior citizen. For a senior citizen, instead of 250, this becomes 3. So there is a change only in this. As against 5% on 250, we apply 5% on 2 lakhs. And for a super senior citizen, there is no 5% slab applicable. So straight 5 lakhs exempt and 7 lakhs is the remaining income, of which 5 lakhs would be taxable at 20%, remaining at 30%. So you see the difference. Tax liability goes down with age, 60 onwards. For a non-senior citizen, for an income of 12 lakhs, so tax liability is 1,72,500. For a senior citizen, it is 1,70,000, and for a super senior citizen, it is 1,60,000. We can have a hypothetical example to understand the tax liability under the old and the new regime. Let's say this is the salary structure. Basic salary 12 lakhs, DA 120, meals allowance 8,000, value of the car as per the figures appearing here 32,400, employees contribution towards RPF nil because it is less than 12%, and this is your interest on recognized provident fund taxable beyond 9.5%. So this is the gross salary. Less standard deduction, net salary. Income from other sources, gross total income. On this gross total income, we give deduction under 80C. So net income is 12 lakhs 1,900. Now, if we calculate tax as per old regime, we will pay tax on 12 lakhs 1,900. But if we choose to pay tax as per new regime, you have to add back One, this 50,000 standard deduction, and two, deduction under 80C because this is not available under new regime. So we add 2 lakhs and then you have to pay tax on 14 lakhs 1,900. So if you are paying tax at higher rate, you are paying on 12 lakhs 1,900. If you are paying tax at lower rate, you are paying it on 14 lakhs 1,900. So this is a comparative analysis. 12 lakhs 1,900 as per old regime gives you the tax liability of 1,79,993. First 250 0, next 250 5%, next 5 lakhs 20%, balance 30%. No 87A, why? Because income is more than 5 lakhs. No surcharge because income is less than 50 lakhs. But cess has to be given. If you opt for new regime, to this 12,01,900 we add standard deduction and we also add 80C. So 14 lakhs 1,900 every 250. First 250 0, next 250 5%, next 250 10%, next 250 15, next 250 20, balance 30. Why? Because balance is up to 250. And 30 is anyways the highest rate. Plus cess 177,393. So old regime you land up paying a tax of 1,79,993. New regime you land up paying a tax of 1,77,393 over the same set of income with same investments and deposits. So definitely the assessee would choose new regime. Why? Because tax is lower in new regime. So that is how Section 115 BAC provides you the benefit of same set of income to be calculated at different rates of taxes and you choosing for the one which suits you the most. So that's where we end with your concepts on salary head. Thank you.